What up, everybody? Welcome back to Royal Blu FX. In today's video, we're going to talk about high probability and low probability setups in the market. All right, a lot of us have the confusion of what a high probability, what a high probability and a low probability setup is in the market. Most of the times when we're trading, about 90% of the people or traders, when they trade, they look at low probability setups and enter and obviously lose the trade, right? 90% of the people actually lose money because there are low probability setups in the market. However, that 10% seek that high probability setups in the markets. Now, there's different occasions of what high probability and low probability is in the markets, which I'm about to introduce to you today. So please stick around to see more. And if you haven't already, go ahead and please subscribe to this channel because we always give out free content, and it definitely helps content creators such as myself to continue posting more videos. And also, if you're just starting to learn how to trade and or have been trading for quite some time and aren't getting the correct results that you are looking for, go ahead and check out RoyalBluFX.com right now to check out our online academy to start learning with us today. So let's go.
Gentlemen, the king.
All right, so there's obviously a plethora of things to talk about in terms of high probability and low probability setups in the markets, why one works better than the other, and so forth and so on. But I'm going to talk about specific ones that obviously we all traders use in the markets. So first things first, liquidity. All right. So a lot of the misconception out there is, everyone has been probably taught or has heard of how to identify liquidity, and even though that's a sort of a kiddish way of identifying liquidity, there's a simple way to identify liquidity, obviously. But a lot of you were probably taught, the double tops, right, to find liquidity, right, and then maybe the double bottoms to find liquidity, right, maybe triple bottoms, right, maybe also a trend line liquidity setup like this, right? You find trend line, you mark it out, wait for price to take it out, and then you go up or something like this, right? I mean, there's many ways, right? You can also find the range, right, or consolidation area, how consolidation builds like this, and then there's liquidity from the highs and the lows, and there's just a plethora of ways to find liquidity, obviously. But this, to me, when I see this, right, and when I see a lot of people talk about liquidity like this to me is a very childish way or kiddish way to find liquidity, right? It's not a bad thing, but it is maybe a step forward into finding or understanding what liquidity looks like. However, let me just say this, actually, drawing it this way or identifying liquidity this way is very robotic, okay? Very mechanical and very, very robotic. Now, you might be asking, why is that? Well, that's because, when everybody is being taught liquidity or mechanical trading, or let's just say, mechanical trading, that we're all thinking about and looking for and seeking for patterns. All right, we don't want to be pattern traders in the market. We want to be specifically looking and seeing what the market is trying to tell us, right, behaviorally or psychologically. Okay, a lot of the market is a psychological way that the market moves, but yet 90% of us, we start to identify patterns, right? And again, patterns isn't a bad thing, right? Maybe just as long as you stay focused on these patterns and obey your and follow your rules in the trading market, right? But I'm here to tell you that this is not the way the market moves. It doesn't move based on patterns. So what I do is normally I teach a lot of my students on how to get away from that pattern behavior thinking, and pattern spotting trends and so forth and so on, but to rather understand why the market does what it does specifically. And once you understand all this, you will then be able to sort of get out of that sort of thinking and start to understand why the market moves, right? So I had a lot, when I started out very early on, starting to learn and see what liquidity looked like, I started to try and put the pieces to the puzzle, right? I was looking for consolidations. I didn't know whether the lows or the highs were supposed to be taken out first, right? Nobody knows anything until you start backtesting for so long, right? When I started out, I was backtesting so much every single day for hours and hours and hours until I found out that obviously the markets aren't the way that we all are putting perception on the markets, the way we think that they should be working, right? So in this case, instead, the markets don't, again, they don't work off of patterns. They just work off of based off psychology. So if I let me just delete this over here, and I'll talk about, for example, how to look for liquidity. So when we have an area where prices are going bullish like this, all right, and then prices then go bearish, you can see that there's a chalk formation here, right? Oop, let me just take that off right there. There's a chalk formation here. Okay, so we have this low broken. All right, and a lot of us tend to think, okay, well, we need to now wait for a chalk, or excuse me, wait for a liquidity to create in the markets, right? That may consist of double tops, whatever, something like that. Then wait for price to come up and then go down, or something like this, right? Many things can occur. Maybe even the trend line liquidity, if you will, something like this, right? And then price will come and take out, sweep all that liquidity, right? Maybe go back up, then go back down, right? It's all a garble of mess, right? But again, I'm here to tell you to not look at liquidity as a form of a pattern, because once you start thinking patterns, or once you see these type of things, right, like patterns, whether it's trend line, double tops, or whatever, you'll be stuck for a while and get more confused. Okay, so the way I trade is simply not looking at patterns, all right? What I tell a lot of my students is, once you find that liquidity, when liquidity does create, essentially that double tops, right, or the ranges or whatever, maybe the trend line liquidity or what have you, right? Once all that has been created, you are already too late, okay? I'm going to repeat that again. Once you find and spot liquidity in the market, you are already too late, all right? And the reason why you're already too late is because once everything is created, right, the market will go and seek liquidity, and liquidity would have been seeked out already, and then it would go in its own intended direction. Okay, so you would already be too late to either react from the market or whatever, right? So what we do in our academy is we teach how to find liquidity before liquidity creates. Okay, and so that starts with that first break of structure. Okay, and not every break of structure is going to be a legit area to where you want to sell from or buy from, right? In this case, it'll be a sell, right? Just because we have a break of structure doesn't necessarily mean the price is going to come there right away, right? That was terrible. Something, like this or whatever, right? Just because the break of structure happened like this doesn't mean price is going to come back and we're going to get what we want and then sell off from it, right? There's specific things that happen in the markets. So that's liquidity is number one, all right? You want to be able to refrain away from looking at patterns. All right, so the other probability setup is the order flow setup, all right? And order flow, as most of you may know, is essentially, let's just say when prices are going bullish, you can see that there's highs and lows creating like this. And this is what a lot of other traders call a trend line, right? Or order flow. Essentially, order flow is an area where prices are going high, then mitigating, breaking and mitigating, breaking and mitigating. And there is stop losses right below the lows, right over here, okay? For the markets to essentially do this, to come below and sweep all the lows. Okay, this will be liquidity in the markets. Okay, so a lot of us tend to think just because we see order flow that we should just get in it and start buying because prices are already going bullish. The bad concept of this is that this is very robotic. Okay, a lot of people don't know, or a lot of traders don't know why order flow happens. Okay, and what is the purpose of order flow? Okay, the purpose of order flow essentially is to create liquidity in the markets, to create as many stop losses for the market, okay, or for the big banks, to come and sweep everyone down, okay? So if we understand this concept, then we have to understand why order flow is occurring, okay? It's for the banks to sweep all the liquidity, for the markets to do its next move, okay? So this is why it's terrible. It's very bad to just look at order flow and say to yourself, okay, the markets are going bullish. What happens if the markets start doing this? Something like this. Right? Now it's harder to see what the market is doing. right? In many ways, the market moves like this. It never moves very smoothly in the markets, right? It just moves so rigidly and so rigid like this that it looks hard to identify what is happening. Well, I'm here to tell you, this is where psychology fits in the market. Okay, pretty much the 10% that always win, that always make money, follow that psychological way of trading, not the robotic and mechanical way. All right. Even though I myself am a retail trader and I do trade the mechanical way, but I add and I put in the psychological part of trading. All right. So that's another thing, that order flow. All right. All right. So number 3 is supply and demand. Supply and demand, as most of you may know, is essentially just lows and highs creating the market. Something such as this, where the price goes up, right? Price goes down. Okay, there's a demand level right here, so a lot of traders will buy from it because that was the low that caused the high, right? Let's just pretend that there's a break of structure there. If I put a line like this, there's a break right here, something like this. Okay, when traders see a break of structure, there was the low that caused the break, this huge impulse essentially. So there will be traders that buy off from areas like this. Okay, same thing with a lot of retail. I mean, everyone is a retail trader except the banks, obviously, but even the break and retest traders, they'll look at these main lows and call it a break and retest, right? They'll buy from these areas, right, and then fail, essentially like this. But not all, it doesn't fail all the time, but the most important thing here is to understand that not every low and every high is going to be equal, right? Because essentially price will fail and then continue bearish. And then now that you're thinking that if prices went up like this, and now you're thinking, okay, well, where's my next supply zone? It's here. Well, what about this supply zone, right? When is price going to come and tap this supply zone? And maybe if prices are going up, you're thinking, oh, geez, maybe something like this where price goes up, comes down, it makes you happy, takes you out, goes up, and then it goes down. And you're like, oh, man, shoot, what just happened? I was ready. I striked here. I lost my money, right? So trading does not work off supply and demand zones, even though a lot of people or a lot of traders say that this is the way it works. Well, it doesn't. Okay, supply and demand is a nice way to illustrate highs and lows in the market, but it's not how the markets move. Okay, the markets are seeking liquidity. Period. They're not seeking out anything else but liquidity. So if there's a high, okay, or a low in this case here, okay, right there. I can't even draw it correctly. Right there. Okay, in each high and each low, there's liquidity. So what we must think and ask ourselves, where's price going to come in and hit next, right? Is it going to come and hit this high, or is it going to come and hit above the high, like say here, and then go low, right? Now this makes a lot more sense. Okay, that makes a lot more sense because if prices go and take out a high, prices have seeked liquidity and then have gone bearish. Okay, and the only reason why we're looking for sells right up here is because price has broken a low, right? So that's what you want to see. You want to see highs and lows being taken out. Okay, and then that's when prices go in the intended direction. Okay, and I don't want to badger the supply and demand, traders. Obviously supply and demand works to some extent, but again, that's not how the markets work. And I'm here to tell you that for a fact, because I'm going to show you here on this chart right over here to the left. I'm not going to give too much away, but I'll show you what's happening here so you guys can understand why and how the markets move based off of my understanding of trading. Okay. All right. So there's obviously many other ways to identify high probability setups in the markets or low probability setups, right? Just to kind of give you an overhead on the low probability setups, there are a lot of low probability setups which look something like this, where prices are going bullish, right? And you see a break of structure. People are buying right at the break. Right, price goes up, maybe makes you happy a little bit, can go bearish against you, or it can go up, right? But what we're looking for here is in our trading academy is where the high probability setups are based off of liquidity. Okay, and if you're looking for liquidity, I want to say this again: if you're looking for liquidity, you are already too late. Okay, just like having confirmations. That's actually another one I want to talk about actually before we get on over here is change of characters or chalks. Okay, so when prices are going bullish, okay, and then you get the chalk formation like this. All right, once a chalk has happened, the market may or may not return back to the order block, or or sort of this supply zone here. It may not, because the thing about the market is it's probability. That's how we need to understand the market. It's all probabilities. And when I've done a lot of back testing, way back then, and I still do back test a lot because I want to be as perfect as possible in the markets. But when I've done so much back testing, I can tell you this: the market is about 50-50. Okay, 50% this and 50% that. So what do I mean by this? I mean specifically that when we're looking for perfect setups, let's just say in this case that order flow that we were talking about, like this, okay, order flow happens for a specific reason. But then we have another way that the market moves. It moves in an impulsive manner like this, okay? And when this happens, you start to wonder what's happening. Why is this move happening, right? Again, in our academy, we explain this. And we talk about this as to why it happens, so you understand how to trade this correctly. Okay. So to talk about this back over here. Okay, when chalks happen, all right, that doesn't mean that price is going to come here and satisfy you and say, okay, yeah, we know price. You know, you're waiting for it here, whatever, you're waiting for price to get there, and it's going to go bearish, right? That's what I'm pretty sure a lot of other traders have been taught out there. That's not how the market works, okay? Although we can anticipate and say to ourselves, well, I'm just going to wait for here. If price doesn't go, you know, if it doesn't come here, or if it does go here, I will strike. But if it doesn't come there, what do I do after that, right? Well, if prices are starting to push bearish like this, now everyone starts to chase the market, right? Lows and highs are creating here, internal lows and highs, you can see, right? And price is seeking out something else all the way down here, right? And all of a sudden, price goes up like this. You're thinking to yourself, okay, well, now there's my break. That's where price is coming. Perfect. This is where I want to sell at this flip zone right over here. You start selling, and then price goes against you. You're like, oh, shoot. That's where I was supposed to sell. Why didn't price go down there, right? Why didn't it go all the way bearish, right? Again, because of the very fact of the psychological nature of the markets. Okay, just because we're looking for chalks doesn't mean they're going to happen 100% of the time. And I'll tell you this: the market only moves in. It gives you about 50% of probabilities in the markets, right? That's why we always have to wait and anticipate. We can't say to ourselves, "Yes, we know the markets are coming here at this supply zone here at this chalk or at this flip zone, right?" And then we're going to strike here right away. We can't say that because that's not, we're not working off of factual things. I mean, even though it is factual that we know that price will get there, but we can't guarantee that price is going to get there and then we're going to be striking right away, right? Instead, we have to anticipate. So prices go down, right? Prices drop. It makes you happy a little bit maybe, right? Then goes against you, right? Now this is a different setup, right? And now you have to understand why price did what it did. And this is where we teach everything in the market, in the academy, excuse me. All right, so I'm going to draw your attention over here to the left over here, in this this area here. I do a lot of back testing on my own, obviously, and I've gotten to understand fully what the market's capable and what it's trying to do. Now, I'm not going to break everything down here in detail because that would be unfair for a lot of the students on our online academy. But essentially what I want you to see here is what we were talking about, especially order flow. Okay, if you look at this low over here, okay, to this high, to this low, okay, there is no beautiful order flow in here. You can see right over here, there's a low, there's a high, there's a low, there's a high, okay. And just because this low created, notice where a lot of buyers were buying right here, okay, right there, and they're all buying. Now again, I don't want you guys to think that I'm trying to bash everyone to say, okay, well, this demand zone worked, so why are you saying it doesn't work? I'm not saying that. I'm telling you that this is not the way the markets move, Okay, the intention of the market is what you need to understand. It's not the mechanical and robotic way that the markets move. Even